BMO ETFs have partnered with investors for over a decade.
Hello, welcome to Strictly Money. I'm Saijal Patel. Longevity risk. One of the greatest challenges retirees face is the possibility that they will outlive their retirement savings. And let's face it, it's not easy to know how much money you'll need in your golden years because every situation is different. You don't know what the economic landscape will be 10 or 20 years from now. You can't predict how healthy you'll be and how long you'll live. But there are steps you can take to ensure you are well set up for retirement. And as part of Financial Literacy Month here in Canada, that's what we're discussing in today's show. My first guest is Fraser Stark, who's the president of the Longevity Retirement Platform at Purpose Investments, and he joins me now with his take on how to overcome longevity risk. Fraser, it's great to have you on the show today.
Great to be here. Thanks, Saijal.
As part of your role, you look at a lot of data and you do a lot of research. How concerned are you about Canadians running out of money at retirement? Because I know a lot of Canadians are worried.
Yeah, that's absolutely right. You know, what we see in the data is that the vast majority of people have not saved as much as they'd hoped for retirement. And so as they're approaching 65 or the point at which they're going to stop working, they realize that while they have savings and perhaps they have a workplace program and there are government programs, of course, they don't have enough to live the type of lifestyle that they'd like to in retirement.
What do you think is the biggest financial issue when it comes to the cost of aging? Is it the prolonged low rate environment? Because let's face it, that's made it quite difficult for people to build wealth. It's put pressure on pension plans. Do you think it's inflation? Do you think it's long-term care and the cost of it? What do you think it is?
It's all of those things, but the bigger and more fundamental thing is the uncertainty around how long you're going to live. You know, when people go to retire, they really don't know whether they've got just a few years they've got to stretch their nest egg over, or perhaps a very long time, many decades in some cases. And it's that uncertainty that makes it really hard to know how to spend your money. If you're looking at an asset and you've got to figure out how much to spend each year, it's challenging when you don't know how many years that's over. And that's what longevity risk is, and that's what we help to solve.
And I think it's an important point, Fraser, because this is a social issue. And I know you guys have talked about this, right? When you have a large a portion of our society that could be facing financial hardship, this has an impact on all of us. You got to think that the government is paying attention to this, no?
They are. I think governments are up to the risk. You've got more Canadians moving into their retirement years than ever before. And as well, you've got people spending longer in those years. And of course, as I said before, a lot of people have not saved enough. So governments are attuned to this. There's legislation working its way through the system to support additional products, advanced life annuities, VPLAs, a new type of pension product. So there is innovation happening and it's slowly working its way through. But Purpose wanted to lead by bringing a product to market that actually helps solve this problem in a way that's available to both retail investors and to institutional programs.
Yeah, I do want to talk about that. You talked about innovation. What type of policies and innovation do you think our country needs to start implementing to start supporting our aging population?
It's really across the board. I think my view on innovation is the government should create the ecosystem or the environment where the innovation can flourish and really just allow products, put in place regulation that allows products that in creative and innovative ways solve the problem, let those come to market. And so far, we've actually seen regulators quite supportive of this. We worked with securities regulators because we've created a mutual fund here, and it took time, but they were supportive of this and they helped bring it to market.
We have about a minute left before we go to commercial break. Fraser, I want to get your thoughts on annuities, because this is an important product. A lot of people do use them and there's a case for them, and yet there's some hesitancy. What are your thoughts on annuities?
Well, it comes back to what you said earlier, Saijal, which is the interest rate environment we're in means the yield someone can get on an annuity is very low today. And so while some people do use them, I wouldn't say many people use them. We understand the adoption of annuities is quite low. And in the industry, that's called the annuity puzzle. Why a product that makes so much sense, an insurance product against living a very long time, is adopted by so few people. And so when we set out to build the longevity pension fund, we really looked at annuities and said, why are people not buying them? What's the holdup? And how do we innovate in a way that improves upon those? So we've done that through both the yield that our fund offers, as well as the redeemability that we offer, so people can reverse that decision.
Okay, we're going to take a quick commercial break then. And when we come back, I want to get your thoughts on different solutions, but also the one that you've launched. We'll be right back.
Sounds good.
Fraser, before the break, we were talking about annuities, and I think the challenge when it comes to decumulation is a lot of people don't know how to create an investment portfolio that actually gives them that regular income stream. So annuities actually does play a role in that, does it not? What's the pros and cons?
Yeah, it's absolutely right. An annuity is helping an investor insure against that risk of living a long time, and it provides income that will last as long as they do. The challenge is that because an annuity is a contract between a person and an insurance company, the insurance company is taking on the risk, the market risk, and therefore they're investing the funds very conservatively, and therefore the yield person is much lower than people expect. So if a retiring person takes $100,000 to an insurance company or to a broker and says, how much income can I get for the rest of my life? That number is often much lower than they're expecting. It's also typically an irreversible decision. You can't go back a year later and say, I want my money back. You've entered into a contract. And those two things, the low rates as well as the irreversibility, make these quite unattractive to many people. It can be a very good solution, but those drawbacks are very real.
Yeah, so in looking at that, you guys, Purpose, launched the Purpose Longevity Pension Fund. Now, so my understanding is this is like a lifetime annuity, meaning that there's a pool of investments, it pays a regular income, but there's an exit option. So explain this to us.
Yeah, what we've done here with the Longevity Pension Fund is we've essentially cut out the middleman between the person's investments and that longevity risk pooling. So it's a mutual fund structure. The fund can be bought anywhere that a mutual fund is typically bought, so through an advisor or a direct trading platform. Mm-hmm. It is invested in the market. So unlike an annuity, it's not a guaranteed product. But because of that, because we're taking on some degree of managed market risk, the pension fund is paying much higher initial yield, and it's designed to rise over time. So while an annuity typically pays a set level for life that with inflation, as you noted earlier, means you're effectively getting less and less each year, the longevity pension fund is expected to rise over time in most market environments. The other thing that people can always get back is their unpaid capital. So the redemption formula is the lesser of the current NAV on the fund or the unpaid capital, where unpaid capital is the initial investment someone's made less the total distributions that they've received. So if something happens in your life and you realize that you need some of this money back, you can redeem a portion or all of the units that you've invested in the fund. And both of those things, the higher yield on the fund as well as the redeemability are huge benefits over annuities, and it's what we're seeing resonate with people well.
Right. So they get back the capital, so they give up the accumulated wealth, give up something. Right. There's a little bit of limitation there. Fraser, let me ask you this. So it is a mutual fund product, not an insurance product. So a lot of viewers will be watching and say, well, okay, then why don't I just create my own balanced portfolio and do the same thing? But this is different because it takes this concept of this longevity risk pooling into consideration. That's right. Can you explain that?
Yeah, and so, we think that most investors should hold a portion of their investments in a product that gives longevity risk pooling, whether it's an annuity or a security like this that offers income for life, and a portion in a balanced portfolio that they can manage themselves. The challenge is if you're trying to create income for your life and you've got all of your assets are in a balanced portfolio, you don't know how long you're going to live. And if you're trying to stretch that, you're trying to make sure that if you do live to be 90 or 100, you've got assets, it's going to cause you to take a very withdrawal each year. And what the longevity pension fund allows is people to actually live on a little bit more of their income because they know that fear of running out that's so real for so many Canadian retirees is not a problem for them. And so it's that uncertainty of how long you're making the assets last for. And what we find, and the research shows, is that most people, unfortunately, err on the side of caution, not surprising in Canada, and end up passing away having not spent as much and perhaps having cut corners in retirement and not had the retirement of their dreams.
So we only have about 30 seconds left. Who does this make sense for? Or maybe another way to ask is what sort of proportion could someone put in this type of asset?
Yeah, that's the right question, Saijal, is how much of someone's, and I think what people want to consider is how much income are they trying to generate? Someone with tons and tons of money at retirement may not have as much need for this, acute need, but how much income is someone trying to generate? And then how much of their assets do they want to make sure is left for their estate to bequest to family or charitable causes? The funds that are invested in longevity are going to be decumulated. It's a decumulation product.
Yeah.
And therefore, if it's important that you leave something to your estate, those assets should not go into this. But for many people, it's 30 to 40% will be a good number, but they should work with a financial advisor or planner on this.
Okay. Fraser Stark, thanks very much for joining us today. Welcome back to Strictly Money. We continue our conversation about longevity risk. There's a lot of focus on accumulation, that is building wealth, but we don't often talk about decumulation strategies in retirement. That is how we draw down our savings to ensure it will last us our lifetime. Jason Heath is a fee-only financial planner with Objective Financial Partners, and he joins me now with his advice on decumulation. Hi, Jason. Great to have you on the show.
Hey, Saijal. Thanks for having me.
So decumulation is not easy, right? Like once you're retired, you're dependent on your savings or investments. You're at the mercy of economic unknowns and volatility in the markets. You don't know how long you're going to live. What do you think is the biggest challenge for those planning for retirement?
Well, I think it depends. There's two ways to answer that question. I think financially, it's finding a way to replace your biweekly paycheck. It's easy when you're working and you get money deposited in your bank account twice a month. But when you retire, some people are lucky enough to have a pension that makes a regular payment. But most people have investments and they need to find a way to turn those investments into a paycheck. Which account do you take money out of? Where do you start? How much can you afford to spend? So the financial side is tough, but socially, emotionally, I think it's finding meaning, replacing, what you were doing at work, maintaining relationships. So there's a whole other non-financial side that can be really tough as well.
Yeah. When you meet with your clients, what are some of the biggest misconceptions around retirement savings that you see?
Well, it depends. I think the clients that I work with, I think are hopefully pretty well prepared for retirement. But taking a step back and looking at it more broadly, there was a survey that was done recently by Natixis. And one of the things they did is they asked investors, what's your rate of return expectation for your investments? And for Canadians, the rate of return expectation was an 11% real rate of return. So that's 11% over and above inflation. And in a 2% inflation environment, that's 13% rate of return. North American markets are up 30% in the last year, but that's not likely to continue. Financial professionals, on the other hand, figured a 5% real rate of return, much less than half. And in working with clients, we often assume lower rates of return. So investment returns is part of it, but life expectancy is another big one. I know it's something that you were talking to a previous guest about as well. If you Google what's the average life expectancy in Canada, I think it's about age 83 right now. But for a 65-year-old, once you've made it to 65 in the first place, your life expectancy is about age 89 for a man and 91 for a woman. So it's important to take that into account.
Yeah, for sure. And, and if you're younger with medical advancements, chances are you could be living until you're 95 or 100, who knows?
That's just it.
Yeah. The strategies to help perhaps minimize outliving your savings. A lot of people are dependent on working part-time. How realistic is that?
Well, I think it can work well for people that receive an early retirement package or just choose to retire early and maybe do a career change. I've seen that happen where people do a career change or go part-time doing something different or do consulting. And I think it can be a great way from a financial perspective to bridge the gap. Some people need to continue to work, but I often see people who choose to continue to work. There's something to be said about working because you want to, and retirement doesn't need to be, okay, I have enough money and I'm done. It can just be, a transition to a different type of working and a different type of living.
Yeah, well, it's nice to be able to choose that and not have to do it, right? Can I ask you about relying on CPP and even things like government support, like OAS, old age security? What do Canadians need to be aware of? Because I'm often hearing, this concern that these could disappear. It might not be around.
Yeah, I mean, that concept gets thrown out. I'd say it's particularly as it relates to the Canada Pension Plan. The CPP is the contributory pension. So, you and I and others, whether they're employed or self-employed, contribute to it. There's money that's set aside. It's invested by the Canada Pension Plan Investment Board. Every 3 years, they do a valuation of the CPP. And the most recent valuation, they found that it should be a sustainable pension for the next 75 years based on the money that's there and life expectancy and immigration and things like that. So I hope it's there for my kids, let alone for current retirees. Old age security is a little more precarious. OAS is a pension that just gets paid based on your years of residency in Canada. We don't contribute to it. There's no money set aside. The government just finds the money every year to pay it. There's limitations if your income is high.
Right.
That one is a little more questionable, but I think generally speaking, most people with low and moderate income can and should rely on those government pensions.
All right. Well, that's good to know. We're going to take a quick break and we'll continue this conversation when we come back.
Sounds good.
Welcome back. Our guest is Jason Heath. Jason, before the break, we were talking about CPP and OAS. When does it make sense for people to delay CPP? Because a majority of people don't, even though they might not actually need the income.
Yeah, I find a lot of people, when it comes to applying for government pensions, they want to stick it to the government. I deserve my pension, or some people, frankly, they just get their application in their mail and they think, oh, I'm supposed to fill this out. I'm supposed to start my pension. You have an option to defer your CPP and your old age security as late as age 70. And often it makes sense, particularly for those who expect to live well into their 80s and certainly into their 90s. Deferring CPP and possibly old age security will give you more lifetime income. You may have to draw on your investments early on, but I often explain to people, CPP and old age security, think of them kind of like a different kind of RSP. The longer you wait to start them, the more they grow. So by not taking them, it's not like you're hurting yourself. You're just choosing one pool of money over another.
Right. Annuities. How do you feel about that? Our last guest, Fraser Stark, talked about the fact that there are some compelling arguments for them, but a lot of people avoid them.
Yeah, it hasn't been a great environment for annuities given how low interest rates are because they are tied to interest rates. I think in theory, annuities are fantastic because people can take savings they have and they can buy a pension effectively. They can buy a monthly payment. It's kind of like life insurance in reverse as well. You buy life insurance to protect against the risk of dying young. You buy an annuity to protect against the risk of living too long. So it can be a good way to protect against that risk. I think the challenge, though, is when interest rates are low as they are right now, it's kind of like buying a 25-year GIC at really low rates. So it's not been very attractive in recent years. But I think as interest rates normalize, as the market develops, and most importantly, as baby boomers continue to move into retirement, I think there's going to be a big boom in the annuity market.
Can I switch gears and ask you about health care costs? Because they're rising. Look, the public healthcare system, we don't know what the quality is going to be like. And this could potentially be a huge cost for retirees. Maybe it's long-term care needs or, a home that they have to live in. What's your advice for someone on how to financially prepare for this? Is it as simple as buying some type of insurance?
It is, and I think you hit on the important one being long-term care, medical and dental coverage in retirement. Oftentimes I have people asking about that. I'm no longer covered by a group plan. Should I go out and buy medical and dental? And my own inclination is you can probably self-insure by paying out of your pocket rather than buying a health insurance plan. And at the end of the day, a broken filling isn't going to ruin your retirement.
Yeah.
Long-term care costs are a big concern, and they can be a big cost. There is long-term care insurance that you can buy that will pay a monthly benefit or will reimburse certain costs for long-term care needs. That can provide peace of mind for sure, but it's a relatively small market in Canada. I don't see a lot of long-term care insurance policies. And I think part of it is with demand, with baby boomers moving into retirement, you might see that market continue to grow.
Yeah, it'll be interesting to see what sort of product or, what they develop for that. We have about a minute left of the show. Jason, what would you like to see then in terms of policy changes or even introduction to different types of products? What do you think could help minimize this longevity risk that so many people are facing?
It'd be great to see more information out there about the benefits of deferring CPP and old age security, given almost every Canadian is entitled to those pensions. I think it'd be great to see things that would incentivize people to buy annuities, maybe some sort of a tax credit or something like that, the same way RSP tax refunds encourage people to contribute to their RSPs. I think policy changes, even just as it relates to the financial industry, would be important. There's so many people out there that don't know financial advisors aren't necessarily required to put your best interests first. Financial advisors and planners aren't necessarily fiduciaries. And I think policy and regulatory changes could help just with the advice that's provided to people that are moving into retirement as well.
Yeah, interesting points. Thanks so much for coming on the show today, Jason.
Sure. Thanks for having me, Saijal.
That was Jason Heath of Objective Financial Partners. Well, that wraps up this edition of Strictly Money. You can catch previous episodes of the show on the newsforum.ca or follow me on Facebook at Saijal. Stay well, stay wise, and stay wealthy. Thanks for watching.